Every single month, a massive, quiet machine processes billions of financial data points, evaluating how you handle money without you ever sending them a single email or statement. That machine is Experian, one of the three major credit bureaus. Have you ever wondered how Experian actually tracks your credit history, how they get their hands on your private financial information, and what happens behind the scenes every time you swipe a card or pay a bill? Most people live with a quiet fear that their credit score is a mysterious black box. You worry that a single minor mistake might silently ruin your chances of buying a house, financing a car, or renting an apartment. You ask yourself, who is feeding Experian this data? Do they track everything you buy? What happens if there's an error on your file? Understanding this system removes the fear and puts control back in your hands. To understand how Experian tracks you, you first need to realize that Experian is not a government agency. It is a publicly traded, global data company. Experian does not spy on your bank account directly, nor do they monitor your daily debit card purchases or grocery runs. Instead, they rely on a massive network of data furnishers. Data furnishers are the institutions you interact with: banks, credit card issuers, auto lenders, mortgage companies, and sometimes collection agencies or utility providers. These institutions have voluntary agreements with Experian and the other bureaus. Once a month, typically at the close of your billing cycle, your credit card company or lender packages your account details into a standardized file. In the United States, this format is usually a system called Metro 2. This monthly data file contains specific, highly structured information. It includes your personal identifying information, your full name, past and present addresses, social security number, and date of birth. This allows Experian's algorithms to match incoming data to your unique file, even if a bank slightly misspells your name. Along with identity data, the file contains account data: when the account was opened, your credit limit or original loan amount, your current balance, and your payment status for that month. When Experian receives this data, automated systems ingest it and organize it into 5 primary categories that form your credit history. First is your payment history. Experian records whether your account was paid on time, or if it was 30, 60, 90, or 180 days past due. On-time payments build a trail of reliability, while late payments are marked with specific codes that linger on your history for up to 7 years. Second is your credit utilization and outstanding debt. Experian tracks your current balance relative to your credit limit. If you have a credit card with a $10,000 limit and a $3,000 balance, Experian records that you are using 30% of your available revolving credit. Third is the age of your credit history. Experian timestamps every account creation date. They calculate the average age of all your open accounts, as well as the age of your oldest account. Longer track records give predictive algorithms more proof of consistent behavior. Fourth is account diversity or credit mix. Experian notes the types of accounts you manage. They separate revolving credit, like credit cards, from installment credit, like auto loans or mortgages. Managing both successfully signals to the algorithm that you can handle different repayment structures. Fifth is inquiry activity. Every time you formally apply for new credit, the lender requests a copy of your credit report. Experian logs this as a hard inquiry. Hard inquiries stay on your report for 2 years and signal to future lenders that you are actively seeking new debt. Beyond financial institutions, Experian also tracks public records, primarily bankruptcies, which are retrieved directly from court databases. Bankruptcies can remain on your Experian report for 7 to 10 years, depending on the type filed. It is equally important to understand what Experian does not track. They do not track your income, your checking account balance, your net worth, your employment history, salary details, or your personal spending choices. They do not care if you spend $500 on groceries or $500 on electronics. They only track whether you pay back the credit line used to make those purchases. The problem arises when errors occur. Because data reporting relies on millions of automated updates every month, mistakes happen. A creditor might report a payment as late when it was on time, or report a balance incorrectly. This is why knowing how the tracking mechanism works is so powerful. Your actionable takeaway to master the system comes down to 3 direct steps. First, audit your data at the source. Check your credit reports regularly at annualcreditreport.com or directly through Experian's free portal. Look specifically for reporting errors in account status, incorrect addresses, or unfamiliar inquiries. Under the law, if you dispute inaccurate information, Experian is required to investigate and verify it with the reporting lender within 30 days or remove it. Second, control the timing of your data reporting. Since lenders report your balance to Experian on your statement closing date, not your payment due date, paying down your credit card balances a few days before your statement closes ensures that Experian records a low utilization ratio, instantly optimizing your score for that month. Third, maintain clean reporting streams. Keep older credit accounts open to preserve your credit length. Keep your credit card balances below 30%, ideally below 10% of your total limit, and limit new hard inquiries to times when you truly need new credit. When you understand that Experian is simply a receiver and organizer of monthly lender data, the mystery disappears. You stop fearing the system and start managing the data stream to your advantage.